So why storage? Because there's a lot of real estate, so why storage?
A lot of people saying that their biggest regret was to stay in the residential side too long. They wish they could switch to commercial sooner. So that's when we decided that, hey, even though we didn't have any real estate experience, we're going to skip the residential and jump into commercial.
So walk me through your first facility.
The tricky part of this deal is the seller. They are 6 family members. So
yeah, that can make it hard to get things done.
yeah, after we put it under contract, it took us 6 months to close. When I wanted to increase the first rent, according to our underwriting, it's a huge jump, 30-40% jump. And Matthew just asked me, are you sure? And we run different scenarios, like worst case scenario, how many move-outs can we afford and still paying our mortgage? And it turned out to be much better than that.
How much did revenue go up?
30% at least.
25, 30,
yeah.
How long is it gonna be before you guys buy new? Are you just gonna keep doing like the same on the year mark? We're just gonna buy one every year?
It's been working so far.
Thanks for coming on, guys.
Thanks for the invite.
Known you guys for a while now. I'm really interested to hear about your guys' first facility, how you got it. But before we get into that real quick, you guys are in Texas, right?
Mm-hmm.
That's correct.
Okay. And how did you guys meet? Because you're business partners.
Yeah.
Right? And you take on different sides of the business. I'm always super fascinated with that. I have partners, right, in all my different businesses, and we have different strengths. So how did you guys meet? And then how did you guys decide together that you wanted to get into storage?
We're also life partners, so that kind of made it easy. And then Jingwen actually got me into real estate and self-storage. I'll let you talk about how we got into that and how you convinced me.
Yeah, so Matthew works in corporate, and he's a financial executive now, inspired to climb the corporate ladder.
Yeah.
That was his original vision. At the time, we were living in New York City, and you know how expensive everything is.
Yeah.
On top of federal tax, there's state tax and city tax. We just realized even you have a very good W-2 income, it's very hard to build wealth if a lot of your income goes to taxes.
Yeah.
And real estate is a perfect place to build wealth. Mm-hmm. That's where how I convinced Matthew to really read the Rich Dad Poor Dad book first, and then look into real estate.
I love it. Especially as you move up in income and you're working so hard, you're spending years at college and then you're climbing the corporate ladder, that tax burden, especially depending on where you live, it is so difficult to overcome. I thought about it a lot when we got started, that I had to double my money just to get back to even. And when people talk about it, they're like, why? And I go, well, the money that I get, I've already lost almost half of it. So I'm investing to try to get back to what I originally made. I have to double it just to get back to what I originally made. And when you start to look at that and do the math, it begins to feel impossible. Yeah. And that's how I felt, especially in trying to invest in the stock market or different things like that. Because I did sales, and we had to live on a small amount of money because it wasn't consistent, right? And so we're like, oh, we'll just invest. And I'm like, holy cow, that's where that idea that I had just a treadmill. I'm running fast, but I don't feel like I'm going anywhere. I'm not doing anything. And same with us, real estate was like, hey, this is a way for us to build wealth, actually take what we've got to keep it and grow it. I think that's something a lot of people understand and can relate to.
Yeah.
It's a big deal. So why storage? Because there's a lot of real estate, right? So why storage?
So I was researching different assets in real estate. Started with residential when I was listening to other podcasts mostly for beginners. A lot of people saying that their biggest regret was to stay in the residential side too long. They wish they could switch to commercial sooner. So that's when we decided that, hey, even though we didn't have any real estate experience, we're going to skip the residential and jump into commercial for the scalability and the forced appreciation potentials. I think that's very.
I love it.
Yeah.
That's what I did too. I was looking at small, especially back in the time, this was, pre-2008. So during when everybody was buying houses, right? That was when everybody's getting rich on houses. And I skipped it and went to commercial for a lot of the same things you're talking about, that forced appreciation. And at the end of the day, I'm like, this makes profit. Like I can actually see it. And that felt way safer to me because there was just expenses and revenue and profit. And the asset, that's what its value was profit. Whereas when I was looking like residential, I'm like, oh no, this doesn't have to make a profit and its value can keep going up or down. It has nothing to do with that. It has to do with what people want. And I'm like, how do I buy if I'm competing with people that are like, well, I don't care if $250,000 makes you, whatever return on rent. I'll pay $300,000 because I want to live here. And so I'm like, it didn't feel like that. So I did the same. We just went to commercial. But a lot of people, I think, when they hear that, though, they go, well, I can't do that, or I don't have the money to do it. And I'm always like, you have to bring it down. Hold on. When you say commercial, that sounds like skyscrapers.
Yeah.
That sounds like something big and scary. The first properties we were buying were worth less than the average home in my state. And I don't live in California. I live in Idaho. So, it was very, very different than I think a lot of people thought. Even the people at the time that were buying homes, they were literally buying homes that were more expensive than the commercial real estate that we were buying. And they didn't even make a profit. They just expected them to go up in appreciation. So walk me through then how you two decided, we're going to skip and go to commercial. Why storage? And then how did you go about that?
I found you.
I'm sorry.
Totally. From the beginning to where I am now, it's the biggest impact is you. From your podcast, I realized that, hey, self-storage is different from other, commercial assets in the way that, first of all, you don't have to deal with a lot of repairs and maintenance or evictions with tenants. That's just a lot less work and the liabilities. And the lease, the month-to-month lease is just beautiful because you can do a lot of revenue optimization.
Yes.
And Matthew also have during college he found a moving company, so he's very into logistics and the operation side of the business.
Yes.
That's when we decide, hey, self-storage is a perfect match for us.
That's really closely, obviously related to storage.
Yeah.
So many of our people come from moving. And when you talk about the logistics and operations, it's true. I try to tell people this isn't triple net lease, right? It's not like you have 5 tenants and then they're in for 10 years and you have a graded scale of increases that you get and the spread is off what your debt cost. And then over time, those increases, and that's your wealth, right? No, this is lots of different people moving in and out, and you are marketing. It is more logistics, similar to like hotels, and obviously moving company is our tenant base is the same. Like if you're renting a moving truck, the high likelihood you're renting a storage. So that's pretty good know-how and experience. What did you think when she started to bring to you, hey, I like this idea of this storage. How did you view the asset class and the industry when you first started looking into it?
Yeah, great question. I thought it was impossible to get into. I was like, residential is a lot easier.
Yep.
You just made me read Burr. I'm doing all this research. Now you switched me to read your book. And then we went to BBCon that year and you showed up by surprise. And we went to dinner and I was like, okay, I see it. I get it. Maybe we can do this. And then, then we really got into it.
Now walk me through your first facility. Are you a new self-storage investor and want to know what that facility is worth, what the risk is, how to underwrite it. Well, that's exactly what we do in a feasibility study. A feasibility study, we actually look at the market for you. We look at the finances, the underwriting, we show you where the upside is, the downside, and all the risk. That is actually what you can provide to banks to get capital and investors. It's a big worksheet which most banks actually require. So if you want to know what a storage facility is worth that you're looking at, come to us, follow the link in the show notes, and we will tell you. First of all, how'd you find it? I think that's one of the things everybody's like, okay, how did you find it? Was it just through a broker or?
Our first deal was through a wholesaler that we got connected with at your conference 2 years ago.
Awesome.
So, networking is very, very important.
Yes.
When you, just look for on-market deals, you have a lot of competitors and buyers to compete with you. So having your own relationship and network is very important. And it took us over 2 years to find our first deal. One was because of the market cycle. At the time, the price was hugely inflated. It's very hard to find a good deal. And the second was, we took our time to refine our buy box and wait and be prepared. And finally, the perfect deal for us at the time came to our lab, and we jumped onto it. I put in the offer 2 hours later, and we came as very strong buyer because the wholesaler knew that we're prepared. We have very clear buy box, and we have very strong financial evidence, and we also have boots on the ground for that location. So even though somebody else is also, putting the offer and with a higher price, actually, they chose us.
What you just explained is one of the major reasons that I see people fail. They're like, well, I'm looking for opportunities and I'm not getting any. And you talk to them about it and you go, well, what are you doing? Are you prepared and everything? Well, I'm not. I'm going to wait till I find an opportunity and then I'm going to figure it out. And I'm like, but that's not how it works. If you don't know what you're looking for, how can you know if there's an opportunity? And more importantly, you're in a place where you're competing with people that are ready. And it is, especially when you get good deals, there is a lot to be said, not only about speed. And by speed, I don't mean that like, oh, I can do cash. I mean, you know what you want. So when you're working with that seller, you already are asking the right questions. You know what you're looking for, because sellers are more concerned today about deals falling out of contract or not closing than anything else. So if you're giving that seller this idea of, well, I don't really know, and I'm not being active, I'm not jumping on this, I'm not trying to get all the information, that scares them. Because they go, I don't know if you really want this, and you're going to go under contract, do due diligence, and just leave. They want to know when we go under contract, it's going to close. Because if it doesn't, that can really hurt me. So as a seller, I waste all that time and that resource. And then two, if it falls out of contract, we put it back on the market. It may sell for less because now people are questioning it. Why did it fall out of contract? So the fact that you were prepared, you had everything ready, you knew what you wanted, that is, it takes time. And you guys, especially because of the cycle, right? So it took time, but then you were able to use that and prepare. Most people, they're almost waiting for something to be handed to them. And they expect it quick. Like I just expect a broker to give me and somebody to tell me that it's a good deal. And I try to explain, like, that's not how it works, right? That's not how it works at all. And you guys went out, made the connections, you met the wholesalers, they knew what you wanted, then the market could serve you what your buy box was and what you wanted. Why? Because you went out and made the connection, so you opened up those channels, and you were very clear. So you have to make a market. I tell everybody this, the market has to be made for you. You have buyers, right? You have sellers, but you have brokers. If I go to a broker and say, I want a good deal, that doesn't mean anything. He's like, I don't know what that means. But then when you go and say, hey, this is the exact facility, market, everything that I'm looking in, the broker goes, I can make a market. Now I can get paid. Now I know you guys are serious. And those things drive deals and opportunity to you. How did you structure it then with the seller. Walk me through the deal. You have an opportunity, you're working with the wholesaler, you've got the seller. How did that go in due diligence? It's your first time, so it's a lot, right?
It was. It's very overwhelming. As a first-time buyer, sometimes you don't have the confidence in your underwriting ability, and if you find something, very small, you sometimes can overreact.
Yeah,
right?
Absolutely.
So this deal was a seller finance deal that's negotiated by the wholesaler.
Yes.
Which is a huge bonus for us.
That's great.
Yeah. But the tricky part of this deal is the seller. They are 6 family members. So
that can make it hard to get things done.
Yeah. After we put it under contract, it took us 6 months to close.
Yeah.
Because there's one family member who didn't want to sell, who wanted to sabotage the deal, and Matthew was leading the negotiation process with them, and finally they were able to buy him out and sell the deal to us. So it's a long process.
Yeah, it was a very long process.
When you guys were looking at this deal, what was the state of the deal? Was this like a really nice asset that was really well maintained, taken care of? Was it something that you're like, we're going to need to do a lot of work? Like, what was going into it? Because of course you have the long process of closing, you have due diligence, but then you have transfer, right? Then it's now, I've never bought a storage facility before. Okay, we've come to a deal, we have it under contract, and then you finally get everybody signed, you're like, yes. And then it's like, all right, now here you go, right? Here's this business that I've never touched, never ran, and I got to transfer everything over. I got to make sure it all works. Was that an easy process because everything was running great or nice, or was it like, no, we really had to dig in? How did that look and work for you guys?
Because the deal was supposed to close multiple times. In the 6 months, it was hard to plan for the transfer.
Yeah.
And then finally, when a transfer did happen, it was a scramble. Because I didn't want to say I need another 2 weeks. I'm like, okay, we're
doing it now.
Let's do it.
Yes.
I'll figure it out.
Yes.
So a lot of stuff happened later than I would want it to happen, just because the nature of the deal itself. But I had a vision, and then I just had to be nimble and work with every problem that occurred just to make it happen. And I had ideas in the beginning that did not work out. And I had ideas, I was like, hey, this is a really good way of doing it. Mm-hmm. And just staying confident with yourself.
What time of the year did you buy this in?
Later than we wanted.
Was it going into fall?
Yeah, we closed after the spring, summertime, right?
Yeah, I believe it's April. Yeah.
Yeah, April 27th.
So when you bought it, was it fully occupied already? Was there room to grow in occupancy or rents, or was it a good stabilized property?
It was close to 100% occupied, which we know what that means. Mm-hmm. So we raised rents immediately.
Awesome.
And then
that's the most challenging part for us, because we expected, hey, we just need to give 30-day notice and everything should be smooth. And there's a lot of hiccups in operations and a switch to a different software. Yeah. Our first rent increase didn't happen until August, so we missed the entire summer.
Yep.
Yeah.
I've done that multiple times. A lot of people don't realize, there's certain things you have to do. If you don't do it right, you can't, and then you have to wait another time frame. You have certain notices that are supposed to go out in certain ways, and it takes just, especially when you first buy it, you don't know, right? Yeah. You're trying to figure it out. How did it go? I can remember some of the first properties that we bought, and I gave rent raises, and that was different than I expected. How did those rent raises, when they hit, how did that go with the tenants?
Got some nice calls.
I bet.
Got some really nice calls. Some of them been there for a really long time. They didn't like it, and I just had to stay strong and stay true to our model and say, we know what we're doing. This is AJ's way. This is what we're going to do.
That's right. My God, this is how it works.
Yeah, I was so scared because I'm in charge of the revenue management part of the business. He's in operations. So when I wanted to increase the first rent to according to our underwriting, it's a huge jump.
Yeah.
It's like 30-40% jump.
Yeah.
So, and Matthew just asked me, are you sure? what if this happened? What if that happens? And we run, just different scenarios, like worst case scenario, how many move outs can we afford and still paying our mortgage? That's our bottom line.
Yeah.
And it turned out to be much better than that.
Yeah.
Good. I think people need to understand, I remember a property that we gave on average, it was 65% rate increase. Because the properties that we're talking and buying, they're so under market rates. And it's hard, especially, we were having conversations with tenants and, some of them came in and they were livid. And I was like, okay, I get what you're saying because you've had this great, amazing deal that nobody else got. But also you have to realize I got to pay taxes. I have to pay the mortgage. So the basis that they had it at is not the same as today. That changed, right? And for us, the facility, even though we bought, hadn't paid taxes because the state owned it. And so we're sitting here going, really, you just had a really amazing, incredible deal that shouldn't have even really existed because one owner had it at such a low basis that they just didn't do anything and touch it, never gave rent increases. But the moment that trades hand, it's completely different. The basis of the asset is different. So the revenue has to adjust and meet. And that can obviously be a shock for tenants sometimes. And it's understandable, kind of why that may be a shock. But what we found was tenants are more shocked if they don't get rent raises than if they get rent raises a lot. And by a lot, I mean consistently. And so it's really that perception more than anything. So we can give tenants, and we have a strict our schedule, 6 to 10 months, rent raises go in. We get nobody says anything. But you go for a facility that has gone years because the owner owned it so cheap and didn't do anything at all, and they had no rent raise, and you get one rent raise, it doesn't even matter how big it is. People are upset, right? Upset. So I'm sure you got a lot of calls. I've gotten a lot of those too. Out of that though, how many actually moved out?
We dropped down to only about 11% left.
Yeah, I think initially it's not a lot at all.
It wasn't, yeah. I think overall,
because the first year. Later, it's a combination of different factors. Mm-hmm. I'm not sure if it's directly related to that rent increase. Yes, sometimes you need to wait like 2 to 3 months to find out if people move out because there is this lag.
Yeah, there is a lag. Mm-hmm.
Yes. But initially, it's not a lot that left. I would say 5 to 10% at most.
Yeah, immediately.
Yeah. And to timing, going into fall, right? To the busy season being spring and summer, so that can also exaggerate those times. But when that occupancy though that left, when you moved into the busy season, were you able to bring in new tenants?
We did bring in new tenants. The busy season would have been this year, and unfortunately, as you know, this year has not.
Yes, it's not been.
Yeah.
Mm-hmm. The summer was like flat.
Surprisingly, yes.
Yes.
But regardless, our revenue just got increased significantly.
How much did revenue go up?
It went up initially, and then we had the little dip, and now it's pretty stabilized with that. I would say it probably went up 30%
at least,
25,
30,
30,
yeah.
No matter how much I say this, I'm like, occupancy doesn't matter.
No.
Occupancy doesn't matter. And this was something that real estate was obsessed with when we got in, and it never made sense to me. You have 10 tenants. You would rather have all 10 full at $100. I would rather have 2 full at $2,000 a piece. I'm way better, right? And even the vacancy. So at the end of the day, that's what matters. Also, like we mentioned before, if you're 100% full, you have nothing to sell.
Yep.
There's no new products. There's nothing to do. Like you're in the business of offering to the public and the rent. And 2, you can't then get the best tenants and the good ones and the ones you want. So you were able to open yourself up so then you have obviously products to sell, and then you can get new tenants. You can get rid of bad ones, which is really important, and you upped revenue by 30%. And what that does to your values, crazy, because that goes to net, right? Mm-hmm. So all of a sudden, you have a 15%, 20%, or a 40% margin. You're doubling it like 6 months, the whole value. With that one, how long was it before you bought your next one?
We closed the next one April 30th of the next year.
Exact year,
Yeah.
1 year.
1 year, basically.
Awesome. Now, how'd that one go compared to the first one?
A lot smoother.
A lot smoother?
A lot smoother. Didn't have 6 owners. So that helped out a lot. That's also kind of like a seller financing note. similar to
Yes, it's also a wholesaling deal.
Yep.
But very interesting part of the deal is it's structured as a 7-year land lease deal.
Oh,
So
yeah. Okay.
that's we never run into anything like
Yep.
that before. But the reason we like it is, one, because it's land lease deal, a lot of competitors, buyers
yeah.
don't want it.
Yep.
That reduces the competition. And the second is, the down payment is not a lot, and the monthly rent is about the same as if the seller does seller financing with 7% on interest only payment. So it gives us a lot of cash flow.
Yeah.
And also give us the option to purchase the facility with a predetermined price at the end of 7 years.
Yeah.
So that's very nice.
I've done land leases before, so I have them. I have today, and it's fascinating with the land lease because the same thing that we ran into when we were negotiating with the owner. At the end of the day, we're like, you have a land lease. I can't get traditional financing. And so they had to finance it. And their property, we didn't need to expand or do anything. We needed to fix some stuff up. But also, it was just so not being ran very well. And that property ended up being one of the most profitable deals we've ever done. And it was on a land lease that was attached to an airport. And this idea of the basis going into it and how important that is in affecting it, I tell everybody, a good deal is relative, right? Like you can have a bad deal, or what may seem like not a very good deal, but it's so cheap, the cash flow is great, and then the returns are great. But you can have also a really nice deal where huge incomes and lots of revenue, but you're paying so much for it, it is not. So you have these different pieces, and the land lease allows, especially in a time like today, a competitive advantage. When financing is easy and cheap and low, you see lots more people that'll just be competitive over everything. So right now to get a land lease is a good time. And that was the same time we got our land lease. It was in 2013, right? So right after the Great Recession, nobody could get financing for anything. And then we got that land lease deal and it cash flowed awesome. We were able to stabilize rents because everything else is the same. It's just a storage facility. And then all that upside was really huge on cash flow combined with the seller finance that we had. And that's kind of how they did. So I love that. That's a great one. And how's that gone now? Because how many months has that been?
5 months.
5,
Yeah. Made any big changes when you came into it or?
Yeah, changed the gate system, implemented, we're actually beta testing KISS locks.
Yeah.
Yeah, the integration with Tenant. So
Awesome.
Yeah, that came in perfect timing.
That's great.
So we're doing that, made that changes, moved on to Tenant, of course.
Yep.
And that one we weren't so shy anymore because we already did the first one. So we did rent raises and demand tenant insurance.
Awesome.
And we did all that in one sweep.
How was that accepted? Did it go okay?
Very well. Very minimal move-outs. It's in a good area. We felt a lot more confidence in this one.
Revenue up?
Yeah.
Yeah, but this one has more delinquency and auctions. So we have to take that into consideration.
That's interesting. I remember the one we bought too had a lot of delinquencies on that one. I think I was mainly just because of the owner, the previous owner. But the delinquencies in the auction part, that can be hard, like especially judging on revenue just because of that lag effect, But obviously once you get them out, move them out, and you can refill that. A lot of people don't realize the auction, we don't make money off that. We can only get what was due. The real loss is the fact that you have an entire space, a rental space, that is not generating anything. You're getting no money from it. The best you could ever do was get it repaid, if that even happened, which rarely does when you auction, right? So it is so important to stay on top of those and kick them out. Nope, you're done. You got to get out, because the opportunity cost of having a renter in there, and it compounds out when you're we could have them at a higher rate. And that's a big thing. A great thing when you buy it, because you're buying it with that problem
Yes.
that you can then solve, and then your revenue per square foot goes way up.
This one had about 17, so not too bad, but it was a good amount of auctions right in the beginning, and had even more delinquency, but got them to settle, got some of them like, listen, you pay this much, get out, call it a day.
Were they on automatic payments, or were they? No. Okay.
Yeah. So that was another thing on both facilities. None of them were on automatic payments. And then I gave them a promotion in the beginning to do automatic payments. And
Awesome.
that gets it up to like 80%, 85, 90.
So you're really streamlining these things now.
Yeah.
You got them automatic payments, you got the gate fixed, you got the new operating systems in, you're kicking people out, you're not letting delinquents, clean that up. You got revenue higher, stabilizing, and that puts you on the perfect course for the next one. So how long is it going to be before you guys buy a new one? Are you just going to keep doing like the same on the year mark? We're just going to buy one every year?
It's been working so far.
Yeah, our goal is to buy at least one facility per year because using the tax benefits and depreciation is a big part of our strategy. With this one, the land lease, our biggest concern is, are we able to do the depreciation on it? So before we negotiated with the seller, we collaborated with our CPA, who is able to really dig into like beneficial owner. As long as you take on the burden of the repairs, maintenance, and the debt of the facility, you're considered as an owner and can take the tax benefits. So in the end, we got all the tax benefits for this facility.
Yeah.
We had an investor that we bought a deal, and we got great depreciation on it. And we were talking about it a year later, and we generally don't do distributions year one because we're turning over the facility, cleaning up everything else. So, and it was funny because he was like, yeah, I got a 60% return year one. And I was like, we were having this conversation. I turned to him like, that wasn't on our deal. Like, I mean, what are you talking about? Like, it's like, no, the depreciation. And a lot of people forget that's a real return. If you have tax liability, that money is gone. It's taken from you. And so when you get that depreciation and you either get it back in your taxes, right, or you don't have to pay it, that explodes that first year return, even on no matter what revenue you're getting. And two, that can be massive. Like that can be more than 2 years worth of profit. So that return, and that's not a return that we factor in. So when we do the underwriting, I don't really look at that, even though it could be a driving motive. Right now, this year, for example, we have a lot of taxes we need to write off due to some selling of assets. And so right now, we're like in a mad rush to get depreciation, right, to leverage it. And so we're not underwriting justifying bad deals, but at the same time, the biggest return we could even get is to get that depreciation in. And how real estate works, everybody, so it's not like you're avoiding taxes. We pay taxes. You got to pay property taxes, you got to pay capital gains taxes, everything else. If you don't get depreciation, you can't do real estate. You would never, it would never even make sense. The depreciation portion on real estate is extremely important to keeping up the assets right, to keeping the money in it, because we can't take it out. And once you do take it out, you actually have to pay back that depreciation. So it's a system where we sell assets, we have to pay capital gains, but then I also have to pay back the depreciation. So the tax bills are astronomical, so we're going and putting in other assets. That's exactly what the government wants. They want you to keep investing your money and compounding it out. And two, by the government forcing us to do that, that also makes us wealthy. Because we're like, yeah, I'm compounding my wealth.
And we also created a lot of jobs.
A lot of jobs and activity. And so I'm glad that we got that. Was it this year or was it last fall? I don't remember. When they finally agreed to lock in depreciation. I don't know why. They always, they do that and they argue it. They always end up doing it. They should just make it
100%.
It should just be done. And this is not, we're not going to come up and we're not going to argue this anymore, and just get it locked in. That way the investing community just goes, we just know what to expect, because that uncertainty is tough. But all right, so one a year. That's your plan. You got this 1 year. So are you already looking for the next one, or are you trying to finish up and finalize the second one you got?
I'm ready for the next one.
Ready?
Yeah, it's on her.
Yeah,
You're like, yeah, pressure's on you now. You're like, go find one.
Pretty much.
As we want to get bigger or better deals, it can get harder.
Yes.
Your competitors are different now.
Yep.
So we're trying to see if we can create a system to talk directly to owners and find some off-market deals. But that's a lot of work.
It's a lot of work. The fact, though, that you guys already have your 2 deals, you've already on board, you've already seen the massive wealth you've created, the revenue change, that I'm sure is helping you a lot on the underwriting side compared to when you just started, where you're like, oh, okay, we can underwrite a lot better now. And that should make you a lot more competitive, especially on deals moving forward. A lot of times when we look at deals, I mean, for us, we don't, whatever the expenses are, I don't even care. Like, it's like, doesn't matter. Here's our expenses, right? It doesn't matter what the expenses are. And then the ones that we don't have control over, like taxes, that's put in. But then to even the revenue side, we can match our operations and we can look and see, okay, well, we've had this experience. We knew this rental rate increase and how this worked. That's a huge competitive advantage when you're looking at a deal and you can go, all right, no, we kind of understand and we can input this marketing, these changes added, we have this much move outs to really nail in that projections and give you the confidence to make a competitive bid. Because the more you're sure that you can hit certain targets, the more aggressive you can get, right? Like I always tell people, I would rather pay a 4 or a 3 cap on a deal that needed work and had upside than I would a deal that was a 6 cap or a 5 cap, but it had nowhere to go. I'll pay a premium to get deals that have upside because I know what our machine can do. Mm-hmm. We can see it. We know it. So then I can be aggressive on those deals and I can get them, and then we can have all that upside and appreciation. So that should help you as you're going along now. You got your 2 deals and keep moving up, and it's like a staircase, right?
That's what we hope, yep.
That's awesome. Guys, thank you for coming on, sharing your story. It's been amazing, obviously amazing having you guys in the group. And since you've come on and what you've done, your patience was awesome. You guys really stuck to it. You learned, and then you took action. And it's paying off. So you guys have done really good. And I'm really excited to watch you guys grow and everything you're going to accomplish. So if for anybody that wants to get a hold of you or know, is there some place we can send people?
Yeah, we have our website, gobeyondproperties.com.
Okay, we'll have that in the link in the bio.
Yep, connect with us. In real estate, it's all about relationships. So
all about it.
We are here to, help each other out and leverage each other's resources and make things happen.
Well, thank you guys. We really appreciate it.
Thank you.